DMX is a multi-sector strategy that allocates across both securitized income and corporate credit markets. So it includes investment grade credit, high yield credit, bank loans. On the securitized side, it includes non-agency residential mortgages, commercial mortgages, CLOs, and asset backs. The strategy is to generate a high degree of income in order to generate a total return similar to the high yield index, but in a multi-sector portfolio that has less volatility. And the strategy is a complement to core portfolios. So if an investor has a traditional core portfolio that has an investment grade risk profile and longer duration, this is a complement, a portfolio that generates most of its return by taking credit risk, credit spreads. DMX is an actively managed multi-sector credit portfolio. It is combining both top-down asset allocation along with individual security selection. So on a daily basis at DoubleLine, we're looking at macroeconomic indicators. We're also looking at individual securities on this portfolio and making relative value decisions. So we might take a high yield bond and compare it to its counterpart in the CLO or ABS market to get a sense of which one provides better relative value. Typically, they offer different features in terms of liquidity, in terms of downside risk, and blending those together is a way to optimize a portfolio. Passive ETFs give you an opportunity to allocate to a sector when it's particularly cheap. But in an environment when spreads are tight and there's nothing obviously cheap, that's when active management becomes a lot more important. So for example, you can buy a BBB corporate ETF. But do you want to buy the whole BBB market, or might it be more useful to decide to select? And having active management in a tight spread environment lets you circumvent specific issues and target those areas that have the highest return potential. I think an important feature in mitigating risk is having individual teams in all of these subsectors that are looking at the asset class all day long. So separate investment grade credit teams, separate high yield and loan teams, within securitized, specific teams looking at ABS, CLO, CMBS, and RMBS. It is typical for investment firms to have asset classes very siloed, where your corporate credit team might be on a different floor in a different building, or maybe in a different city than the securitized team. Since we're all here on one floor, we're all talking to each other daily, it allows this cross collaboration, which really for a credit portfolio is key, where we're able to make individual security selection decisions and regular relative value decisions on the fly. And I think that that's a key distinction relative to our competitors. The simple proposition of DMX is that sectors of the fixed income market are not cheap all at the same time. So if you think about securitized income and corporates, they broadly are not cheap at the same time. In an economic cycle, when there's weakness, corporate credit tends to weaken first, and then securitized follows. And then in an improving economy, typically corporate credit improves and spreads tighten first, and then securitized follows. Opportunity for DMX today is that yields across credit are very attractive relative to where they've been in the last 10 years. And there's a chance that credit will outperform equities in 2025. The equity market is pretty expensive. And if you can create a credit portfolio that generates a high single-digit return, you might actually generate a higher return than equities. And even if you don't, you're doing with much less volatility.